Do we have a rally going on in the S&P? They're up now, flirting with 4,200 again.
Look, I think the market is expecting that 4,200 ceiling to hold here. If the S&P manages to get through it, there's a little bit of blue sky out there simply because that's where all the hedges are. So expectation that we're essentially fair valued here. Most of Wall Street says this is, we're fairly valued here. You can't get much higher. And as you know, when all the bears say the same thing and all the strategists say the same thing, the market tends to go in the other direction. So in part, the market rallied so hard this week on the expectation that the debt ceiling was going to be taken care of by this weekend, by Sunday.
Well, that's what I talk about, and not just this week, but this year so far. Isn't the S&P up something like 9%, something along those lines? So what is doing that? Is that because the earnings came in better than the expectations, which had been taken down, or is it because of the Fed?
So there's a couple of things going on. The first thing is there's actually a lot of liquidity in the system because Janet Yellen at Treasury has been adding liquidity to the system to pay the U.S. bills, which is helping stock prices and specifically NASDAQ prices as well. That 9% increase in the S&P this year is essentially driven 85–90% by 7 stocks. It's not that other stocks aren't up. It's just that they're not heavily weighted enough to drive the index to this level. So you've got 7 stocks driving the index. They're all large cap tech. They're also associated with AI. So you've got overlapping stories here driving the index higher because it's concentrated in those really powerful names that drive the index.
So Gerard, let's turn to you on the question of the banks because that liquidity we're getting from the Fed to some extent is, if I can call it, the reversal of quantitative tightening because of what happened in the wake of Silicon Valley Bank and the other banks. Should we expect that to keep going, and are the banks going to keep drawing down on that liquidity?
I really, it's going to be interesting. It's a great question because the deposit flight is over. We know from what we saw in the middle of March when the Silicon Valley Signature and First Republic banks failed. Now, First Republic technically failed, obviously not in March, but at the end of April, early May. And I would say that the deposits that we saw today, they came out this afternoon with the H8 data. And what you saw with the H8 data was deposits are down slightly for the larger banks. Smaller banks generally flat to down. And so there's really no need to have to pull down liquidity, even though we still have, of course, discount window borrowings and the backstop borrowings with the bond portfolios from the Fed. So there's plenty of liquidity, as Alicia pointed out. And I think that the banks are certainly going to benefit from that as we go forward.
So, Alicia, if we don't have the problems with the depositors, it appears at the moment anymore, does that mean we're past the problems with the banks, or are there other things perhaps lurking out there?
So I think the immediate problem of the small and regional banks has been ring-fenced for the most part, and that's what you see actually in the equity market, because the bank sector is underperforming everything else, and every other sector is more or less all right because it's not as affected. So the ring-fencing and the policies that the FDIC and the Fed put together in March have been very helpful in that. I think ahead of us lies some consolidation in the small and medium-sized banks. Stock prices are essentially reflecting a valuation across the entire sector, which is more or less equal, even though there are very different members and operating businesses within that index. So not every bank is the same, not every small and regional is the same. So there's some opportunity there. The issue really is about whether the banking crisis is over, is how it affects the real economy and what it does to lending. And that is going to be a slow drift downwards, not right away. We've already seen lending start to contract 3 quarters ago, very slowly. It increased in the first quarter, the contraction. But the question is, where does that affect the real economy? Because as you know, the U.S. has held up pretty well. The data's been pretty good.
What about that, Gerard? How much credit tightening are we seeing? Do we have a real current read on how much credit tightening has gone on already?
David, the Senior Loan Officer Survey came out a couple of weeks ago, and certainly the banks have been tightening their underwriting standards for many months now. But more importantly, what it showed was the demand for commercial loans and commercial real estate loans was down quite a bit. So the banks are always willing to lend. They're in the business to make loans, of course. However, in more uncertain times, they take a more conservative underwriting approach. In a case of a commercial real estate loan, they're going to ask more of a down payment from the owner of the property, and that may make it prohibitive for the owner to buy that property. So you could argue, yes, they are tightening. We agree with that. The loan growth in the second half of 2022 was extraordinary. It was almost 10% for the industry. It's definitely slowed down. Typically, it grows at the nominal rate of growth, and that would be, right now, nominal real GDP growth. If the Atlanta Fed number is correct, you may have seen this week the real GDP number forecast came in at 2.9%. With 5% inflation, 4% inflation, whatever number you like to choose, you're looking at nominal growth of 6+% right now.
Gerard, let's get specific right now for a moment about Morgan Stanley, because we did get that big news. Surprised a lot of people that James Gorman decided to step down, I think after 13 years or so. What did he do? What is the legacy he leaves behind? And will his successor continue that legacy or maybe head off in a different direction?
It's a really good question, because James Gorman has done a very good job. When you think about when he took over about 13 years ago, Morgan Stanley was in a very different place. And through the acquisitions of the old Smith Barney wealth management business, as well as the acquisitions more recently of E-Trade and Eaton Vance, he has diversified the revenues of Morgan Stanley, where wealth management now is about 45% of total revenues. Investment management is also a bigger presence today. And the investment banking and trading businesses are much smaller contributors than when they were back in 08 and 09, which means it's a less volatile source of revenues and earnings going forward. So when he hands the reins over within the next 12 months, his successor is going to obviously continue balancing out the revenue stream, because it has worked very well. The stock valuation for Morgan Stanley is much greater than his peer Goldman Sachs. And under his tenure, the last 13 years, his stock has outperformed just about all the financial bank stocks, with the exception of JP Morgan.
Alicia, we've gotten through this entire wonderful conversation without talking about what the Fed's going to do. So how much of that is supporting what we're seeing right now in the stock market right now, the anticipation that the Fed will back off a little bit on the tightening?
Look, I think that's part of the reason that equities have been so buoyant. The expectation, not just that the Fed is going to pause in June, but we're going to get rate cuts by the end of the year. Virtually everybody you speak to says, well, the Fed's not going to cut by the end of the year. So it's very curious to see who's pricing in the cuts in the second half of the year. But, to the extent that inflation stays sticky, and we've talked about this, that the goods sector is clearly in a disinflationary downturn. You've seen it in large cap box stores when they're talking about lower revenue. It's because the goods are coming lower in prices. But it's the service sector, core services, core inflation, core is at 5.5, core services at 6.8% inflation. The Fed's job is not done. And the interesting question is all this signaling that, June is not going to be a go. What if June becomes live? And then you get a repricing both in equities and bonds.
Well, it's fascinating. And what do you anticipate in June?
So I think the Fed's going to try very hard to signal that it's open, likely not to go. But if you get a bad inflation read and a very strong non-farm labor report, the Fed could go.